We did a trade on Tesla. They have earnings after hours, and I made a bet that it was going to gap up or down, but inside of this range, inside 405 and 334. This is what's called selling premium on elevated volatility environments. So here, the probability of Tesla gapping all the way down tomorrow after the earnings announcement is a higher probability of doing that. That's why the volatility expanded. Your profitable range is a lot wider when you're selling volatility that is at 103%, right? This is the expected move here. So if you are new to options or trading, the options market right here, this is the options market, is a prediction market. They predict how much the stock is going to move up or down. They don't know if it's going to go up or down, but because of the premium, the volatility that's priced in, the implied volatility, right? This is implying that with the 68% probability that the stock is going to close within 22 points to the upside and 22 points to the downside. So knowing that information, I can now sell the strike that is 22 points away or more and 22 points away or down. So if volatility, which is typically overinflated, right? 70% of the time, volatility contracts, which means 30% of the time it expands, right? So what we're doing is we're selling high volatility. This position right here doesn't expire for another 2 days. So see days, this is your days to expiration right here. This tells you how many days before this bet expires. So this bet is selling the 340 put. I sold insurance. I sold insurance at 340, meaning if it doesn't get into an accident at 340, right? So what is an accident? So an accident is this. If you have a stock chart, right? And Tesla, right, is currently trading at 374, right? If I add 22 to the upside, that gives me 396, right? That's the expected move that if it does gap up, it's going to hit up to about 396. Anything above that, that's where you make money if you bought this call. But I sold this call, right? Because I think it's going to gap up, but as long as it stays below 396, what did I sell? I sold the 400, right? So if you look here, I sold the 400 call, right? Whenever you see a negative, that means that's the one that you sold. The selling the put, right? 340. I sold the 340 put, right? So I sold the 340, but let's subtract the expected move downwards, right? Most people don't know the math behind options and trading, and this is the math because I'm a math teacher, right? That's my background. I always want to teach people, well, why does this make sense? If the math doesn't make sense, it don't make dollars, right? Our mathematical edge is that we don't think it's gonna get below 352, right? And 352, I sold way out of the money. I sold the 340s. And you asked, Nick, why did you sell the 340s? Because if you actually look behind the curtain, remember, as options, these are all just bets. These bets are all going to expire. What I saw was the big volume, right there at 340. But look at all this volume and open interest at 400. So this is where a lot of bets are being placed. So I want to stay away from that retailer. This is their play. They're buying these bets or they're selling them. So most likely market makers are going to want to like scare them, push it down, and then potentially come back or settle near there within the next 2 days. So what I did was I sold right at that move, that 400. That's how I was able to get some premium. 400 is outside of the expected 397, and it's right at where the people bought it at, right?